Hi, Matt McAleer, Director of Equity Strategies, October 15th, just after the close. Good bid in the equity markets. Maybe that's why I have a little pep in my step today. After some choppy work mid-September through last week, we started to see some demand come back into the markets. What we like is that it was broad-based, a lot of breadth, a lot of sectors working. Even from a capitalization standpoint, large worked, mid worked, and small worked. So we're seeing some real solid demand in multiple areas. That brings me into a conversation for today's video. And that is some of the things we battle as traders and investors. We always hear about greed and fear, right? Those are the two big ones that we always have to be aware of. One of the other areas that we try to concentrate and at least recognize is bias. Bias that's been built in for many years of investing. And when we recognize that, we can try to stay flexible. What I wanted to speak to today was recency bias. Recency bias is the thought that what has happened recently will continue to happen into the future. And what we've seen over the last 5 years, and even more specifically the last 10 years, is real strength out of large cap growth, represented, let's say, by the S&P 500. Microsoft's, Google's, Apple's have really carried the market for the last decade. By the way, very different than the previous decade. From 2000 through 2009, you had to be allocated to small and mid cap versus the S&P 500, or you didn't make any money. The S&P 500 net of dividends was priced flat for that decade, while you picked up close to 50 and 60% in small and mid. So we came into the second decade thinking small and mid. We leave the second decade with the S&P having been King Kong. If I was to pop up this first chart that I want to share with you, that is a 12-month run of S&P versus mid cap versus small cap. Now, we're not going to complain about the performance of any of them, but from a relative strength standpoint, wanted to try to get an idea of what's working. If I were to ask myself blindly or clients, I would be willing to bet that the orange performance, the orange line, would be labeled the S&P 500, with maybe mid cap second and small cap third. Yet when I bring up the second chart, where the symbols are attached to the performance, you see that small cap has been a monster the last 12 months. Mid cap darn well had great performance as well, darn good performance as well. Large gaps versus the S&P. We come out of that decade thinking S&P, S&P, S&P. Perhaps the constant drop in yield had an effect on the performance of the S&P. We have to stay flexible to the fact that over the last year, when yields have picked up, still low, but certainly have picked up, we've seen outperformance from small and mid cap. Similar, by the way, to the first decade of the 2000s, where you had nice rips in small and mid versus the S&P. It's just something to be aware of, to remain flexible. In terms of our portfolios, U.S. core is overweighted to small and mid. U.S. equity, which includes industries and sectors, is also overweighted slightly to small and mid versus large cap. Now, we understand that that won't be a week in, week out scenario in terms of what outperforms, but we have to think flexibly. If we're looking at perhaps a 2 or 2.5% 10-year a year from now, 18 months from now, 2 years from now, what is that going to have meant for equities? It's interesting to me that year-to-date value and growth are neck and neck. Again, value's been dead money for a decade. Now we're seeing a bid to value. And more importantly, on each pullback, values getting bought. Previously, value would rally, then fall apart. Nice to see, very constructive to see this breadth. I'd love to see a continuation in multiple areas of the equity market working. That makes for a healthy equity market. If you have any thoughts or questions, we have put a survey on the screen today, as well as down below the screen. We'd love to have you answer a few questions about our videos. Try to give us some guidance on what you want to hear us speak about from week to week. We do these videos for you. We do them for our clients. We do them for our friends. That will give us an idea of where we can focus most of our attention. Everyone have a great weekend. We'll see you next Friday.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors. Today is Friday, October 15th, late in the afternoon. Well, we had some mixed economic news this week. CPI came out higher than expected, although ex-food and energy, it was pretty much on par with expectations. We had initial jobless claims that went below 300,000 to 293,000. That's the lowest it's been since pretty much the pandemic started, and it's lower than it had been creeping up, as we talked last time, to almost close to the 400,000 level again. So we'll see what happens next week with that. Retail sales were up very strongly. People are still buying things, and also prices are going up, as we've all heard or continue to hear about supply chain disruptions. It's either long-term or temporarily increasing prices. And in contrast to retail sales being up, the consumer confidence survey that's taken by the University of Michigan, those numbers were down, so consumer confidence was down. So it was a little bit mixed. So the bond market reacted somewhat. Treasury yields went down. The 10-year went to a 157 from a 161, and the 30-year went to a 205 from a 216. So yields went down a little bit and prices improved. Meanwhile, Muni yields only changed about a basis point each. The 10-year ended at a 117 and the 30-year at a 168. Important for the Muni market anyway is the ratio, the Muni Treasury ratio. Munis in the 10-year are now yielding 74% of the 10-year Treasury, and the 30-year is yielding 82%. This is up. That makes Munis more desirable, relatively speaking. So we've seen some uneven economic numbers emerge, and rates have been up and down, and I think long-term still seeing rates are going to be a bit higher, trying to approach 2% by the end of the year, maybe not quite that high. We'll see what happens. And also last week, some of our viewers mentioned that they enjoyed hearing about the funds flow information into and or out of mutual funds. So municipal mutual funds, actually, the inflows went back up to about 461 million, and most of it was in the longer term Muni funds, which totally makes sense with the ratios improving. The yield of Muni is a little bit higher than it had been before. Thank you, and look forward to seeing you again.